S&P 500 endures its worst week of the year. Hello, my name is Marcus and this is your weekly market wrap-up. On Monday, equities sold off steadily throughout the day and the S&P 500 lost 2.3%, registering its biggest one-day drop of the year. The major averages were pressured from the opening bell as global growth concerns returned to the forefront. In China, first quarter GDP rose 7.7%, which was below the expected growth of 8%. The disappointing report added to the weakness of the commodity complex, which saw an extension of last week's selling. Gold miners endured a rough session as the market vector's gold miner ETF fell 9.9% on the heels of a 9.5% plunge in gold to $1,356.80. Meanwhile, silver tumbled 13% to $22.90. Tuesday brought some relief as the S&P 500 climbed 1.4%, while the economically sensitive materials space was able to rebound and end atop of the leaderboard. The defensively geared consumer staples were not far behind. Staple stocks received some support from Coca-Cola after the beverage giant narrowly beat the Capital IQ earnings estimate. A defensive bid was also buoying the healthcare sector, where Johnson & Johnson gained 2.1% of the bidding on earnings. Sellers re-emerged during Wednesday's session as the S&P 500 tumbled 1.4%. Technology stocks fell to the brunt of the drop as the SPDR Technology Select Sector ETF lost 2.1%. Apple dipped below 400 for the first time since December 2011 and settled lower by 5.5%. Thursday saw a continuation of Wednesday's selling. The S&P 500 shed 0.7% to close below its 50-day moving average for the first time since December 28, 2012. Cyclical sectors were under pressure, with technology stocks once again finishing among the laggards. Elsewhere, the cyclical discretionary sector also finished in the red as home builders slumped. The major averages entered the weekend on a mixed note. The S&P 500 settled higher by 0.9%, while the Dow Jones Industrial Average ended with a slim gain of 0.1%. The 30 stock Dow trailed behind the broader market as General Electric, McDonald's, and International Business Machines (IBM) pressured the price-weighted index after reporting earnings. The three names, General Electric and McDonald's, reported in-line results, but the two anchored the ongoing global growth concern with their commentary. IBM, meanwhile, missed on earnings and reported revenue more than $1 billion below the Capital IQ consensus estimates. Shares of IBM tumbled 8.3% to surrender all of their year-to-date gains. In summary, the S&P 500 index finished last week down 2% and has been lower 4 out of the last 6 sessions. The Dow Jones Industrial fell 2.2% and had its worst week of the year. The tech-heavy Nasdaq fell over 2.6% for the week, despite Friday's snapback rally. Market watchers have been calling for a correction as stocks rose over 10% since the start of the year, and this could be the beginning of that scenario. Exchange volumes rose sharply on the down days this week, which could also signal a shift by investors out of equities. Economic data has continued to soften and earnings. Market bellwether IBM fell by 8% on Friday after a disappointing quarterly report, and Apple lost more than 9% for the week. These companies could be signaling clues for the overall economy. Over the last 4 years, the markets have experienced a spring swan, and after a run since January, we may be setting up for a repeat. Commodities fell sharply this week as investors fled in droves. Gold futures fell almost 5% for the week, despite trading higher from Tuesday to Friday. Monday's sell-off of 8% was one of the biggest one-day declines in gold ever. Silver and copper followed gold's lead as both plummeted on large volumes. Oil futures fell 2.6% for the week, which should begin to help consumers as fuel prices fall. The Chicago Board Option Exchange Volatility Index spiked 24% for the week as stocks fell. Friday saw a huge drop in the weeks as the market staged a rally, but gains in volatility from earlier in the week won out. The fear gauge showed the risk-off trade was in demand as equities fell. Option premium rose as demand for protection grew all week. Despite the downturn in equities, Treasury demand for relatively tepid. The yield on the 10-year Treasury fell to the lowest level of the year and is currently at 1.7%. News out of the Eurozone was limited as continuing debt issues rhetoric took a break this week. Growth in Europe continues to slow, so a solution to the issues may be a ways down the road. Rumors of a rate cut by the ECB may provide some relief, but this is not expected until May or June. There are 170 of the S&P 500 and 10 Dow Jones Index companies reporting earnings this upcoming week. Major tech companies such as Apple and Qualcomm report along with industry including Caterpillar and Triple M's. As of last Friday, 1/5 of one S&P 500 had reported and the two-thirds had beaten expectations. Despite the decent EPS numbers, slightly more than half of those firms missed revenue estimates. The week ahead is light on data, but all are important. Housing data on Monday and Tuesday, along with durable goods Thursday and GDP figures on Friday, will provide plenty of potential catalysts. And this wraps up your Market Weekly Wrap-Up. And I'm Marcus. Seeing you next week. Bye for now.